Another set of earnings, dhamaka one at that. Sundram Fasteners, they've hit a milestone of 5,000 crore rupees revenues, 500 crore rupees bottom line in FY23. In fact, Anisha just caught up with the CFO, Dilip Kumar, on the way forward for the company.
In FY23, you managed to hit the run rate of 5,000 crore per annum with respect to revenue, and even the bottom line was quite healthy. What about FY24? What kind of numbers you're targeting?
So the company achieved the twin milestones of crossing 5,000 crores and the profit after tax of 500 crores. But the FY24 looks quite promising and the domestic market with the huge infrastructure spent by the government, which they have announced, of 10 trillion rupees being an election year, and also the vehicle scrapping policy. So I think the domestic market will hold good, and especially the CV sector and the passenger vehicles also with the semiconductor issue sorted out. I think the demand continues to be very strong, and we also expect the tractor to come good because of the favorable monsoon which we expect. So overall, I think the domestic markets are buoyant, quite strong, and the unexpected support has also come from e-commerce. I think e-commerce and auto components, auto industry have become strange bedfellows in the sense that they need last mile connectivity, and the auto sector is able to provide through light commercial vehicles that last mile connectivity. So overall, I think the domestic market will go and quite a strong year is what we expect.
Okay, so the domestic market continues to be strong, especially led by e-commerce as well as good monsoon is something which will drive it. But this time around in the quarter gone by, there was also a positive surprise with respect to the margin performance, right? It came in closer to 16%. Could you talk to us about how it is likely to trend from here on and what led to the margin improvement in Q4?
No, the margins got compressed a couple of years back, and going forward, so if you remove the inflation of EBITDA, and that trajectory of years time.
Okay, and what about your take with respect to how the exports are likely to pan out? Because you talked about how domestic growth continues to be strong. What about exports?
The exports, as you know, that there has been a bit of slowdown in North America with high inflation being experienced there, and the Federal Reserve have raised interest rates repeatedly, and we expect things to moderate. But having said that, I think our order book, our EV pipeline especially is quite strong for the next 5 years. We are building on our EV product portfolio. And these are large orders which have been won, $250 million for e-axle sub-assemblies. So I think that will keep us in good stead in the years to come.
Mr. Kumar, just coming back to the point on the margin, would you say that in the coming year the margins will be 17 to 18%?
Well, I think, yes, definitely 17% is what is our aspiration to touch this year. But yes, it is possible.
What about your Capex plan? Because if I have it right, earlier you were talking about the Capex momentum to be between 350 to 400 crore per annum. Are you on track to that, and what are you doing with respect to funding this Capex?
Yeah, so we said last year we would spend about 1,000 crores over a 3-year period. We are pretty much on target to achieve that. We have already spent 300 crores in FY23, and we expect that to be on course over the next 2 years, especially for the EV projects, which I mentioned a little while for our e-axle sub-assemblies. And given the Capex size of 300 to 400 crores, I think our internal accruals, cash accruals are very strong. And with, as you know, you would have noted our profits were 464 crores with a depreciation of 160 crores. It's a huge number, 600 crores plus of cash generation. So we are quite comfortable, and I'm sure we will finance these Capexes with internal accruals. There might be slight incremental borrowing, but as of now, I don't even see that.
And that's
our
actually...
our debt equity ratio is strong at 0.15, and so we should finance it through internal accruals.
No, fair enough, and that's quite reflected in your return ratios as well. Whether you look at return on capital employed or ROE, those factors point to a healthy profitability as well. But any change in the capital allocation policy that you are anticipating? Are you looking at more acquisition given the cash flow you said is quite healthy, or maybe returning higher dividends, etc., to the shareholders? Anything in the pipeline?
Yes, the strategic, as part of our strategic initiatives, definitely we look at inorganic opportunities, be it in the same sector or allied sector, which will, improve our sales and provide the thrust to our growth going forward. So we are looking at opportunities.
Okay, good to know that you're looking at opportunities, but you were also talking about expanding and diversifying into areas of hot forging, bevel gas, EV parts, wind energy parts. You talked about some of those, but just wanted to understand what could be the product mix going forward, when it comes to these new verticals as well, the likes of EV versus the traditional ones?
Yeah, so EV, we would like to ideally in about 5 years' time get to about 15% of our revenues coming from EV products. But as far as hot forging and wind energy, in all of these are not new segments to us. We've been in this business for, especially in the hot forging, we've been in this business for 2 decades, and in the wind energy segment for the last 10 or 12 years. So we are adding more products, and as a part of China Plus One strategy, we are talking to European customers. So these businesses will grow in the coming years.
Just wanted to understand what's the exposure of the CV vertical as far as Sundram Fasteners is concerned, and the overall percentage exposure to the non-auto business, because the street wants to understand what's the what's the diversification strategy to get out of the cyclicality.
Yeah, I will answer your second question first, which is the non-auto space. Currently, we are 1/3 of our revenues come from non-auto. In be it tractor or wind energy or our industrial segment, engine segment. So our non-auto vertical is quite strong and profitable. And as far as CV is concerned, yes, we have a significant exposure to CV in the export market and to a reasonable extent the domestic market. But I think the CV segment will continue to grow in the next 2 years. With, after the pandemic, people have increasingly adopted online shopping. So the e-commerce is driving this, not only in India, even in Europe, it is driving the truck sales. So I think the next couple of years are quite exciting for the CV industry.
Okay, on that optimistic note, we'll let you go, Mr. Kumar. Thank you so much for making time and speaking with us. So the growth trajectory looks quite strong. The domestic outlook, given the e-commerce demand as well as the good outlook from monsoon, is something that Sundram Fasteners is talking about, and the margins too are expected to stay around that 17% mark. Thank you, Mr. Kumar, for joining us today and talking to ET Now.
Thank you. Bye.